So today we have Todd Russell, who is not only a CFP professional, but also the president of Shoriance in Nashville, Tennessee. Welcome, Todd, and thanks for joining me.
Thank you, Kevin. I'm happy to be here.
Okay, good. So today we're going to talk about what I would call the next generation of long-term care insurance. So Todd, I started in this business maybe after you did. We'll learn a little bit about your background, but the first generation of long-term care insurance was, hey, we got this great product. You can cover something that's really devastating, and then it seems like the prices just ran up. Everybody was upset. Premiums got out of hand. Some people got a really good deal, and then a number of companies went bankrupt. So today we're going to talk about some of the newer products that are out there, and I think there's really a second generation of products as well as planning that we can do as financial planners. So I think the reasons why people might want to watch this video and see if long-term care planning is right for them is number one, long-term care really is a part of financial planning. It's a risk, and our pilots do have the risk of long-term care maybe wiping out some or all of their savings and investing. You know, if the assets are needed to pay for long-term care, either at your home or in a facility, you know, they're going to have to come from somewhere. And so by having this as part of your plan, we think that's really important. We'll talk a little bit about what the costs are of long-term care, as well as the fact, and this is something I've learned very recently from you, that aging in place is becoming a much bigger desire for people and something that can be done now. So if you know, it's not the just going to the long-term care facility, the nursing home. So that is something we'll discuss as well. We'll actually talk about some of the new generation products that are out there that really some of the behavioral finance issues that people have had over the years of, you know, not being able to buy something because they feel like they're going to have a loss or they just have loss aversion. There are some new policies out there that I really think allow people to feel good about getting some of these policies. And some of these policies are, you can use them if your long-term care issue happens, and you can also use them if you won't use it, but your family will use it if you die. And so there's multiple reasons why we might want to think about long-term care planning. So Todd, first of all, tell us a little bit about yourself and what your background is.
Yeah, so I started in 2002. I was fresh out of college and I was engaged to be married and I needed a job. So the first thing that came up was a corporate job in the insurance world. So I learned some of the internal workings of the insurance profession, and then I moved to Nashville, Tennessee to open an office. And then one of the things that I did is I gravitated toward the financial planning community because I had just a personal belief that insurance solutions are good and important for people, but the best context for them to be used in is in a financial planning context, which that's one of the reasons I got my CFP designation. And I just think that's a good place where it matches up. And so the last probably 7 or 8 years, I've focused on working with other financial planners and just being their insurance specialist on their team.
Thank you, Todd, for that. Yeah, full disclosure, Leading Edge Financial Planning, we're fiduciary financial planners. We don't take any commissions, but we do like to work with companies like Todd's here, Shoriance, that do help non-commissioned planners like ourselves. So let's jump into long-term care. So how is long-term care insurance, Todd? How is that a part of financial planning, or how do you think it should be a part?
Yeah. Well, let's define first what long-term care insurance or long-term care planning is, just to make sure that we're kind of singing out of the same songbook. So when we talk about long-term care or a long-term care event, what we mean is that someone maybe, as they age, become feeble and frail, and they just lose their ability to live independently. So someone needs to be there with them to make sure that they're doing the basic things: eating, bathing, dressing, taking medications, all those good things. Then the second thing in long-term care is if somebody develops a cognitive impairment, where they have dementia or Alzheimer's. And again, someone needs to be close to them to help them. So when we talk about long-term care, we're talking about custodial care.
So, you know, like, I'm guilty of this. I'm guilty. I'll put my hand up and say I'm guilty. A lot of times we think long-term care means nursing home. or a facility. And I think that's been changing. Is that right?
Yes, it sure has. And so, kind of like you said, most people, when they think of long-term care, their thought goes directly to a nursing home. And a lot of the times people just want to put their head in the sand and not even think about it. But
Sure.
care now can be provided in your home or in other facilities outside of a nursing home. And frankly, most people want to age in place at home before a facility anyway. And so developing a long-term care plan can help you stay in your home if that's what your goal and your desire is.
Yeah, yeah, I can tell you, I like my chair. I like my TV. I wish it was bigger, but you know, everybody wants a bigger TV. But I really would prefer to stay at home personally. So I think to me, that's part of the risk management here is that you might be able to stay in your home if you do have the resources and the ability to do so.
Mhm.
So let's talk a little bit about you know, what long-term care costs.
Yes, so it really depends on your geographic area. So I'll give you a couple. So
Sure.
in outside of Birmingham, Alabama, where there's a situation I'm very familiar with for in-home care
Mhm.
from just a neighbor providing it is roughly about $20 an hour.
Right,
If you go through an agency in the same area, it would be $26 an hour.
right,
It depends on who you hire. If you go an agency, it's a little
sure.
more than just a friend or neighbor or maybe a retired nurse. And then where I live now in Franklin, Tennessee, that cost jumps up to about $30 to $33 an hour. So it really just depends on where you are for the home care. And then same for a facility, Kevin, is depending on where you are. You know, it could be as low as $8,000 or $9,000 a year up to 15 plus, depending on if it's a private room, semi-private room, etc.
So did you say 8 or 9 thousand per month? It's not per
Correct.
year, right? Okay,
Yeah,
okay. I
yeah, per
just
month.
wanted to
Yeah.
make sure I heard you correctly. Yeah. So the facilities. So I don't know how many hours there in a week. I probably should, but if you have to hire somebody, let's say $20 an hour, what does that actually mean per year? You know, because you're dealing with this yourself. Do you have
Yeah.
any understanding of that?
Yeah. So to the penny. So 30 days a month, $20 an hour for round the clock care is $14,400 a month.
Wow.
So it's pricey, but if your desire and goal is to keep your loved ones where they're familiar, then you do what you have to do.
Kind of the old paradigm thought process. Paradigm's the fancy word. Sorry about that. The old process was that you know you have a need, you want to fully cover it. So how is that changed now, where people used to want to cover 100% of the long-term care expected costs?
Yeah, yeah. Well, I mean, to echo your point, that's the way 15 or 20 years ago, when insurance agents and advisors would propose it to their clients, they would propose it based on fully insuring that risk.
Hmm.
And the premiums were very inexpensive, but then over time, they've proven to increase. And
Hmm.
so now, what if we were to take that same strategy and look at fully insuring, the premium cost when you look at them just may not be something that most people would stomach. So I don't see a lot of people choosing to fully insure what a potential long-term care risk is or what it could potentially be. What we're seeing a lot of is it's sort of either budget driven or benefit driven. So just as an example, let's say if I think that $15,000 a month is what my projected cost of care would be if I want to remain in home. Well,
Hmm.
I may say, well, why don't we consider a policy for a third of that? So maybe a $5,000 a month policy, because really in reality, working with you and your team, you guys are going to be generating income for them throughout the remainder of their lives. But what a long-term care policy can help with is it'll help relieve some of the pressure that the portfolio would have to generate extra income to cover those increased costs. So really, and this goes back to the initial question you asked, is how should
Sure.
long-term care be a part of financial planning? Is it's just mitigating risk, and it's transferring some of the risk from your balance sheet to the insurance company. And if I need long-term care, then those first few $1,000s come from the insurance carrier, then the remainder can come from cash flow or social security or assets.
Yeah, that's perfect. I mean, let me break it down for our clients. Let's say that you think you need 12,000 a month or 14,000 a month in expenses, and now all of a sudden long-term care becomes an issue. Your spouse or you have to age at home, and so now your costs are $25,000 a year, maybe $30,000 a year, and so that extra cost, that money has to come from somewhere. And what I find really fascinating about insurance, and the thing I like about insurance, is that people actually do use it and spend the money. We have seen some people, Todd, that have long-term care episodes and they do not want to spend their money because it's their money. But if they had an insurance policy, they actually would go ahead and get the care that they need for either themselves or their loved ones. So I think that's a tremendous benefit. But coming back to it, so really what you're saying is that long-term care policies now, it's a certain period of time that they'll cover, or will they cover you for the rest of your life? Will they still cover you?
Yeah, so good question. You can have a policy as short as 2 or 3 years,
Right.
and you can have a policy that'll cover you throughout the duration of your life.
So you really have the choice now. That's the new generation of products. You have the choice if you want to try to mitigate some of the risk, which is really where I think that's mostly our philosophy at Leading Edge Financial Planning is it's really hard to mitigate all of the risk, especially if somebody's going to be in a facility for 15 years. But you can mitigate some of the risk, and like you said, keep the pressure off of the other assets. So you can either use the other assets, leave them to your children or charity. So
Mhm.
I think that's good. So as far as a financial plan, we use a number of financial planning tools. How do you recommend as a CFP professional to model long-term care expenses and then which policy to choose?
Yeah, so I think, a lot of software you can do a Monte Carlo simulation in it. And, maybe you're at 90 plus percent, but then when you put a 3 year, 2 to 3 year long-term care event in it, maybe your percent of success goes down. And so there's one way where you can model of, okay, if we, even though you have those expenses that go up, if you have a five or six or $7,000 long-term care cash flow going in to mitigate those expenses, your success rate still could be high. So typically what we would recommend, and this is a little bit of art and science, Kevin, because you
Sure.
want to kind of make sure you're insuring for a right amount, but also it's got to be something that comfortably fits in someone's budget or their cash flow, because people could spend outrageous amounts of dollars on premiums. And that could also, if times get tight, that's often the first thing that goes by the wayside. And so you just wasted money on it. So our philosophy at Shariance is find the amount that is right for you, but let it fit in your budget. That needs to be the overriding factor. And then also when we work with other professionals like you, I mean, you're involved in the process and you help us determine what's the right amount based on their plan. So really we figure out what's the right amount and then go through an educational process, because kind of like you said earlier, a lot of people, their understanding is the traditional nursing home, long-term care. You pay a premium, the premiums go up over time. But today there are a lot more consumer-friendly options. And one of the big reasons why a lot of people don't really care much or didn't care much for discussing long-term care, because it's a use it or lose it proposition. So you could pay premiums for 20, 30, 40 years, pass away and never need care, and then all that money had been spent and it's gone by the wayside. And
Sure.
you really have four plans. You got a traditional long-term care benefit. You
Mhm.
have a life insurance policy that has a long-term care rider on it. And then
Mhm.
you have a hybrid plan that mixes some of the life insurance and the traditional long-term care benefit. And then sometimes when people are a little older and maybe a little less healthy, there
Mhm.
are long-term care annuities that can help provide some leverage on funds for that. But I'm really just going to talk about the first three.
Okay.
And Kevin, one of the ways that I like to analyze an insurance solution is looking at it through the lens of what happens while you are alive, what
Mhm.
happens if you quit and don't want the policy anymore, and what happens when you die. So I'm going to talk about those three components on
That's great.
traditional. So So we've already talked about a traditional policy, but as
Uh-huh.
long as you're alive, you pay a premium and you have a long-term care benefit. And if at some point in the future you quit paying your premiums, generally your policy just goes away with no value, no benefit from it. And then whenever you die, same thing. There's no death benefit or generally no return of premium on those policies. So traditional long-term care is just a pure insurance solution.
Yeah, and it's insane to me, Todd, because you have like clients that say I'm rooting for myself to have a long-term care episode so I can use my insurance because I don't want to lose the money, but they don't want to use it. So anyway, let's continue on with the next one.
Yeah. So the next one would be a life insurance policy with a long-term care rider. And I actually have a policy like this on my wife. So I'm going to use her policy as an example. So as long as she's alive, we pay a premium. And if she ever needs long-term care, then her
Mhm.
death benefit can be advanced to pay for her long-term care cost. So as an example, her policy is 500,000, and if she needs long-term care, then it pays out at a rate of 10,000 per month. So as long,
120,000 per year.
yep, that's right.
Okay.
And then, so as long as she's alive, those are her benefits. There's a premium and a benefit. If she quits, a portion of those premiums would be refunded because there's a cash value component to the policy because it is a life insurance policy. It's not going to be a lot, but if you quit, you can get some back. And then whenever you pass away, then back to the use it or lose it topic, if she never uses long-term care and passes away, then her $500,000 death benefit will go to me if I'm still alive or our children as a primary beneficiary. But if she uses, let's say, $200,000 of care and then passes away, then the 300,000 that's left would also pass on to the beneficiary of the policy. So that concept helps overcome, like to your point, where a client's like, I really hope I can use it and have a long-term care event. Well, this kind of helps alleviate that, where you hope you never have a long-term care event. But the
Right.
numbers tell us differently. 50 to 70%, depending on who you read, 50 to 70% of people are going to have a long-term care event. So that type of policy helps provide care for it, but also if you never use it, inheritance goes to children.
So let me go ahead and pound the table on this one. It's use it dead or alive, basically. If you're alive and you need it because long-term care becomes an issue, you can use it. If you do not use it, you leave it to your loved one that you wanted to leave some money to anyway. So you have the regular long-term care insurance, you have a life insurance policy that
Yep.
also has a long-term care rider, I guess is what we would call it. Is that
Yep.
right?
That's right.
Now you have the hybrid. Tell us a little bit about the hybrid, Todd.
Yeah. So the hybrid takes a little bit of the best of both worlds in and combines them. So back to the live, quit, or die. So in the hybrids, as long as I'm alive, I have a premium, and the premiums are fixed and predictable.
Sure.
So if I'm paying it to age 65 or over a 10 payment window, the premium 10 years from now is going to be the same as it is today. So that's an upgrade from a traditional long-term care policy. While I'm alive, if I need long-term care, my monthly benefit, if it's $5,000 today, I can add an inflation component. So maybe that $5,000 increases by 3 or 5% compound inflation every year that I have that policy. So my pool of care is going to grow over time because you know better than I do the cost of healthcare increasing over time, and it's generally more than 3 or 5%.
Sure.
Um, and then, so as long as I'm alive, there's premium, and I can have it, like you mentioned earlier, over the 10 pay paid in full. But if I choose to quit, same thing, there's a portion of my premiums that could be returned. And then whenever I pass away, generally the amount of premiums that I paid in would be returned to my beneficiary. So you're not getting leverage or a lot of leverage on a death benefit, but your family's getting basically the premium returned.
Yeah, no, that's great. I mean, the loss aversion is, the struggle is real when it comes to the loss aversion.
Yep.
We all either lose something or the potential to lose something. We don't even like that as well.
I
So
was going to say, if you have clients that are interested in, and a lot of the times, Kevin, when folks are interested, that they're not really sure where to start
sure.
because a lot of the times people they don't want to get sucked into some sales dude who's just going to try to sell them something. A lot of the times they just want to look for information and answer the question, number one, how does this work? And
Right.
two, what is the cost of this? And so one of the things that we do at Surience is we just have complimentary consultations where we'll schedule a phone call with folks, do a Zoom meeting like we're doing here, and ask a couple of questions and spend time educating folks on how a policy works kind of from top to bottom. And then a lot of the times when we're on the phone, we'll just run customized proposals with various carriers that we work with to help answer those questions of what it might cost and what it might look like for them individually. And so really the best way to find that out is, we're always happy to have a conversation with folks if they call us and are interested.
Yeah, no, I think that's perfect because yeah, you are really concerned sometimes to, become the person on the hook and then the insurance person will leave you alone. Been a lot of jokes and movies made about that. So anyway, we'll continue on. So my last question is, all right, I'm a pilot. I'm in my 40s. All of a sudden, I'm in my 50s. All of a sudden, I'm in my 60s. When is the best time to start? Obviously, the best time to start this conversation is earlier, but how early?
Yeah. So I have worked with people who are as young as 36 who put a long-term care plan in place up to 74 who has put a long-term care plan in place. So, and there's a couple of things that drive that
Mhm.
is a lot of the times if people have someone in their family going through a long-term care event, they see the disruption in the family that it causes, they see the cost, and they don't want to be a burden to their children or to their family. And so the average age of someone buying a long-term care policy is 57, or the typical industry statistics. So, but also you have to be in a position where, when you're younger, you've got children, family, you're building your wealth. So there needs to be an appropriate time for it. But one thing that often goes unnoticed and I think unthought about is there is a medical component to a long-term care policy. So typically, the younger you are, the insurance cost is lower. And typically, the younger we are, the more healthy we are. So every year, just something happens and we get an age older. And
Mhm.
um, everybody does that. And then same with health, we get a little closer to not being as healthy, get some bumps and bruises on us. So typically, the younger the better, but it's also got to be a right time within your career. You might be putting kids through college, et cetera, and the best insurance that you could have is term insurance to replace your income. Long-term care may not be on your radar at that point or a need yet.
Leading Edge Financial Planning LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.